territory for the second week of December 2025. And as you can see from that chart, if you're watching this, markets bouncing around a little bit, but especially the US market and US small caps in particular, ending the week up though. And in contrast, emerging markets, global small caps, pretty much in the middle where they started, up a little bit, but showing much less volatility as we've come to expect. The US market more broadly was kind of a little bit more volatile, but just jumping around a little bit. And the main theme in market seems to be people questioning whether this really is a bubble, how you even quantify that. And that's probably affected the tech stocks the most. And Australia ending up where it started off, not that volatile as well. But where the real focus has been in bond markets and especially short-term markets. But even that picture that you can see down the bottom looks like a flat line, but edging up for the local market, 10-year rates there, and edging down for the US. Now, when you zoom out a little bit to the last 5 years, you can see that divergence just, month on month over the last few months has actually become quite significant, almost 1% up for 10-year yields for Australia, while US rates have flatlined. And you might also notice to the left of that chart that the last time this happened was in 2022, when we had that inflation surge in the US that was followed by Australia. And there was a sense then that Australia was going to be perhaps more afflicted by inflation and it was going to stick around for longer, but actually it just followed the US path and rates came down again, although by not as much. So if we zoom in on what's happened across the rate curve, you can see down the bottom of this chart, it's really been across the whole curve. So 1 year rates, and that's the one that perhaps your clients are focusing on more because the implication for mortgage rates is that they're above where they were at the start of the year. So that respite that markets expected and that's been factored in by about sort of 1% drop in mortgage rates has really been taken away. So you might expect to see upwards creep in actual mortgage rates based on what's happening in underlying fixed interest rates. And really this is the source of the divergence. What we've got here is 1 year expected inflation backed out of interest rate markets, and you can see it's been coming down quite precipitously in the US, maybe signs of a slowing economy there, and going up in Australia. Now, to be fair, it's not just Australia. This is to some extent a US versus the rest of the world phenomenon. Could be rooted in what's been going on in the trade negotiations and America versus the rest of the world to some extent. Although, again, if we look at what happened from an inflation point of view, there is still the possibility that where the US goes first, Australia goes after. Now, this is a different setup than 3 years ago, where we saw that spike in inflation in the US that really set the tone. That's where a lot of the stimulus came from. And in Australia, there was a sense that it was going to stay around for longer in Australia, but we followed the rest of the world and the US with a bit of a lag. Maybe the setup here is that there is something genuinely different going on, the structure of the economies, but what would make it the same is if this is to do with a slowdown emanating from the US, and a global slowdown would affect Australia from a cyclical perspective. And that's probably the perspective that Andrew Hunt has taken, that some of this is a little bit overcooked. There are capacity constraints, that's one of the things he's noted, but on the other hand, if the world slows down, so might we. And despite what Michelle Bullock said this week about it really being, I think their worry is that maybe they've cut too much too early. Andrew, on the other hand, feels that maybe in the next few months they might be given a little bit more leeway. But again, you've got to be careful what you wish for, because that probably means a weaker global economy. And the other thing you have to bear in mind is the markets are quite often wrong about this. Now, what this chart on the left-hand side shows is the divergence in opinions between economists, and the histogram beside that shows the spread. And you can see it is fairly sort of evenly spread. There are some outliers, and that sort of ranges from about 2.8 to sort of 3.5% or something like that. So, within that range, there is an expectation that things settle down, they don't get out of control, but it could go either way from here. And that's certainly what it looks like for the February RBA meeting. As they said, as Michelle Bullock said, and as has been implied, it's a live meeting. So if you're worried about your mortgage, or if your clients are worried about your mortgage, it could go either way. But let's see what happens in the next few months in the global economy. And we'll be talking about that next week with Andrew Hunt in our kind of end of term wrap up, and looking forward to next year. In this week's What We're Working On video, we talk with Joel Sasim, one of our analysts who specialises in private markets, and James Fleiter of BetaShares, who's a director for private assets. And this was off the back of a paper that Joel did, which you'll find as a link in the weekly newsletter, or you can find on the portal if you're a client. And also, JT attended a conference which was attended by a lot of our peers, and also importantly, Alan Kirkland, the Asset Commissioner, where he talked about three things: managed accounts, the Shield Guardian affair, and also the third thing was private credit, and some interesting insights there which we talked to Joel and James about. And the overall takeaway, if you don't have time, is that there is going to be another raft of surveillance. It's going to focus on the private credit sector, and basically the tenor of it is there's a move to increase transparency, reporting regulations within the sector, which we think is pretty much about time. And as James discusses, it'll reflect more and more what you see in the US. Transparency's got to be a good thing. But saying that, ASIC's still supporting the role of private credit in the local economy, and overall the intention of the post-GFC regulatory environment here and in the US was to push the risk out from the systemically important banks, and that's what's happened. So they still support that, still a role for private credit. But you've just got to be careful doing your due diligence. The bar's been made higher, and what ASIC are saying is every person in the step of due diligence, from the trustees, the responsible entities, to the platforms, to the research houses, to ourselves, and including advisors, the bar just got higher. So lots of work to do there. If you're interested in a little bit more detail, tune into the video with Joel and James, and otherwise look forward to talking to you again next week. Thank you.